Welcome to this week's current federal tax developments for the week of July 16th, 2018. I'm Ed Zollers presenting this week here from Phoenix, and we're going to be presenting updates on what's happened in the area of federal taxes. As always, this weekly update is brought to you by Kaplan Professional Education and by your state society of CPAs. This week, we got a few things. We're going to take a look at the additional things we've seen this week for fallout from Wayfair. We're going to talk about the IRS's update on security guidance for tax professionals. The IRS gave us a signal that I'd always thought was going to be coming, that tells us that, in fact, we were not at risk for losing executor and trustee fees as a deduction after the Tax Cuts and Jobs Act, but some people were worried about that. The IRS did stick to its position regarding prepaid real estate taxes when asked about it by New Jersey's Attorney General. We'll talk about that. And we'll also talk about something that's gotten coverage all this week regarding the IRS. An employee of the IRS on their Tax Talk Today webcast gave what's kind of a semi-official endorsement to the backdoor Roth IRA structure. And so that's also kind of an interesting little development. So with that, let's start out as we have recently with this week in Wayfair, because that's been our big issue. Now, we've had a few things happening this week in the Wayfair arena, and a number of states have started doing things. We've seen various other issues happening. On the things we have written up in our PDF that we always have available for you to download on the website, we're going to start first with an issue from the state of North Dakota. North Dakota had a press release from North Dakota State Tax Commissioner, Ryan Rauschenberger, that was issued on July the 11th. And what that did was we know North Dakota was the first state right out of the gate on the day of the decision that updated their website, informed people, look, you got to start collecting sales taxes. This is a big deal. We're serious about it. Now, North Dakota gave us the official guidance that October 1st is the date that they're going to start wanting to see people who are selling from out of state, did not have physical presence in North Dakota, begin to collect and then start paying over the sales tax. Information obviously is on their website. They do have interesting stuff there. They have a memo that it goes into detail. If you sell in North Dakota and other states, they're sending you to the streamlined sales tax registration system to sign up. So if you have multiple states there, you go there. If you only are an out-of-state seller and the only state you're selling into and you have to register with is North Dakota, then they do have a sign up for you just in North Dakota without going through the streamlined sales tax program. Again, North Dakota is going to use the $100,000, 200 transaction minimums that we saw that were basically commented on favorably in South Dakota. North Dakota is using the streamlined sales tax system, which has the advantages that Justice Kennedy commented on in the majority opinion in Wayfair. So it appears fairly likely that the Dakotas are going to be collecting sales. They're going to be able to force you to collect sales tax. And it looks like October 1st is our start date in North Dakota. South Dakota is still negotiating out the deal with Wayfair because, of course, that was a case that got sent back to court. But that's not the only state. North Dakota was. And we had a couple of other things happen. South Dakota, or I should say South Carolina. I'm going to mix those up because, you got South in both. And, okay, the two Souths. We'll talk about that. South Carolina is going to follow South Dakota's minimums. That was announced in a July 9th letter to the General Assembly from the Department of Revenue. It was issued on July the 9th, as I said. And what they're going to do, the South Carolina Department of Revenue indicated that the South Carolina Code has allowed for ages the imposition of sales and use tax on all retailers, including remote sellers. And they're going to say, look, we're going to start actually doing this. So what we're going to do, they're going to finalize their guidance in the upcoming weeks, but they did indicate that they plan to use that $100,000 of good, 200 or more transaction trigger for those companies which do not have any other reason to file in South Carolina to have to file with South Carolina. Again, going back behind the protection of the majority opinion that indicated that those minimums were, quote, reasonable. Finally, we also got some more follow-up information here from the state of Wisconsin. This is Announcement and Statement of Scope, SS 079-18. That was issued actually on July 5th. What this is the rules that implement the out-of-state sales tax collection. by administrative rule. Wisconsin had mentioned that they were considering what limits to use. Not surprisingly, they're going to use that same $100,000, 200 or more separate transaction rules. That's going to be the trigger level we're going to expect you to start filing with Wisconsin. Now, we've had a couple of other things happen in the past week. Nothing official yet, but we have two state legislatures that apparently are gearing up to come into session. New Hampshire's state legislature apparently has come into special session. They're looking to pass a bill to actually try to make it more difficult for states other than New Hampshire. So let's say if you have a New Hampshire seller who's selling into South Dakota, this one will probably be difficult for them to beat, but they'll try. If they're selling into South Dakota, they're going to put a bunch of roadblocks where you have to go to state court to get a judgment and get a finding that your state law doesn't violate the U.S. Constitution. They want to put that in their law. Why would New Hampshire want to do this? Well, New Hampshire is one of those states that doesn't have a sales tax. So not surprisingly, New Hampshire businesses are not terribly thrilled about having to collect sales tax for other states. And it's a real big, kind of fire them up, get the troops running position to take in New Hampshire. So the governor is behind it. The legislature is coming together. On the flip side, the state of Utah is preparing a proposed bill with the expectation that they will call their legislature into special session to do just the opposite. That is to start forcing out-of-state sellers to effectively collect the Utah sales tax. They do not believe they have the guidance on basically they don't have the statutory authority, they believe, yet to do it. So they're going to enact a statutory provision. Obviously, now they're negotiating how they would structure that deal. So keep your eyes open because we're seeing a lot happening here in state and local taxes. But there are a couple of constants we probably can look at here. First thing is, in our trends, a lot of states are using that October 1st, 2018 start. Now, this is not unanimous. Some states believe that they actually are collecting backwards. Rhode Island recently backed off. They had stated they were going to go back retroactive as far as they could. Now they're saying, okay, maybe not. Hawaii also now has announced that they're not going to go back to the first of the year. They had legislation that would have taken effect, that would have been applicable the 1st of January 2018. Interestingly enough, not passed till June, but, hey, what the heck. They have now announced that they're not going to go retroactive. That's probably good news. We're going to see how others use that date. Massachusetts still believes their cookie nexus was valid all along, and they'd already told you it was October of last year. So they're not planning to back down, at least at the moment. But a lot of the states that are now coming in and now are going to start trying to do some real collections, that weren't actually being aggressive ahead of that, those states are tending now to look at that October 1st, in essence, the beginning of the next quarter, as the date on which they're going to want people to start collecting sales taxes. The other pattern that we're seeing, and this one is more clear, we're seeing more and more states use South Dakota's minimums. It is becoming fairly obvious that states are drifting there because they feel that Justice Kennedy's opinion blessed those minimums. As such, with blessed minimums, they want to go ahead and make sure that that's the number they're using. So not surprisingly, expect a lot of states to be there. That does help us know a few things. Number one, your clients probably need to be told, or if you're in business, you need to get ready to potentially have to start collecting these taxes on October 1st. At a minimum, be ready for an October 1st start in the states you may be exposed in. Number two, you really do want to now go back, run that report of sales, looking over the past year. And some states are doing it based on a midsummer test. Some are doing calendar year. Just run last year. I mean, they're obviously, if you're right on the edge, then it matters what the testing period is. But let's just take a look at, let's say 17, maybe the easiest to get to begin with. But secondly, hopefully your system's sophisticated enough that you could find, let's say, from July 1st of last year to June 30th of this year. You can run the numbers and just take a look and see what states are we selling into that we do not currently collect tax for, and that we don't have any other reason to be there, that we've had more than $100,000 in revenue, or that we have had more than 200 individual transactions. Those states are the ones right now to laser focus on figuring out what your compliance issue is going to be. Also, take very, very close. You can fully expect that all the streamlined sales and use tax states are going to jump on this bandwagon. There's little reason for them not to. So I'd certainly say those states also consider to be highly the states that you need to make sure you're going to come into compliance with. You also need to start working now, because you may very well discover, if you have to do a bunch of states, that you may need to be looking at the whole integration to your systems to be able to integrate into your invoicing or online sales system. And that work's not going to happen in a minute or two. That's going to be additional work. So obviously you need to get moving on getting this done. Anybody who's in this area should be working on this problem right away. The next little thing we had, the IRS. Remember, we've talked about this before. The IRS has their Security Summit. And the IRS has basically issued a news release, which is IR 2018-147. And it's got a huge long title. Tax Security 101. IRS Security Summit partners launched new awareness campaign, urged tax professionals to step up protection for client data. This was released on July the 10th. Now, there's a couple of interesting things that they've done. They did decide to change some items that they've had already. Okay, couple of things happened. The IRS has revised Publication 4557. That is a publication on safeguarding taxpayer data. They also released a brand new publication, 5293, the Data Security Resource Guide for Tax Professionals. Everybody in tax practice should review those two publications. By the way, a lot of the security work is also going to be very similar for any accounting information you're keeping on the system for clients. So if you do, they're A&A clients, if you have an A&A non-tax client, that's still probably going to be key to make sure that you've taken some of these steps to try to fix this. Some of the things they talk about, some of them are pretty obvious. They tell you to learn how to recognize phishing emails, especially those pretending to come from the IRS, a tax provider, a cloud storage provider, or a taxing agency. The bad news is they say never open a link or any attachment from a suspicious email. That's kind of like telling somebody never pay money to a con man. If you could recognize it was a con man, they wouldn't be a con man. If you can recognize the suspicious email, it's not a very good phishing email. So you got to be careful. I mean, what they're saying is correct. Couple things to train your staff. Never, ever, ever believe that an email comes from who it claims to come from, unless you have a solid reason to believe they really would be contacting you. Be especially aware, and I think that is important what they said, of any email that says it's coming from the IRS, that's coming from your software provider, like, from CCH, if you're ProSystem FX, from Intuit, if you are on Lacert, from Thomson Reuters, if you are using UltraTax. Be very, very suspicious of any email that claims to come from those organizations. Any email coming from a cloud storage provider. That includes not just the big three, which is Microsoft and Amazon and Google, who are the big cloud storage providers, which if you're a large organization, you may be contracting directly with. If you're smaller, you may still be using them. Let's say like any of their, shall we say, they're more retail products like Microsoft's, Cloud Drive, Google's storage that they have for their file services, the GFS service. Amazon also has storage that they offer. You can buy, those sorts of things. You might be using those. But also things like your backup sites, like for instance, maybe you're doing offsite backup on Carbonite. Be suspicious of any email that claims to come from Carbonite, because again, they may be asking you for data. Obviously, these guys realize you're probably using offsite backup. Carbonite and the others are big, kind of well-known entities. If I can somehow get your credentials to get your Carbonite backup, I just got to your data. So obviously be highly suspicious there. And also any other taxing agencies like, your Department of Revenue. Be very, very suspicious of those. Be aware and make sure everybody in your organization is aware. Those organizations should never ask you to provide things like, private information. If they tell you you need to log in to do something, go directly to their sites. Do not click the link in the email and then log in at what you see at the site. That is very, very, very easy to spoof a web page. That's how you phish things. They also suggest you have a data security plan using IRS publication 4557. and also the Small Business Information Security publication, The Fundamentals, from the National Institutes of Standards and Technology. That's probably very helpful, useful. Go ahead and review your internal controls. Make sure you have anti-malware, antivirus software on all devices. That is probably necessary, but is nowhere near sufficient to solve your problems. Be sure that you create passwords that are long, and long is key. Number one, a password should be long. Longer, the better. Number two, complex is always nice. If we can add extra characters like upper lowercase, that's always nice. Number three, absolutely crucial, use a different password for every account. Now, in order to do that, the IRS this time added the requirement, said you really should be using password managers. I know a lot of you are going to resist that. A lot of you are going to say, wait, that's one point of failure. That's true, it is. But the problem is, if you use the same password on 30 sites, that's also one point of failure. Because somebody who knows you are a tax CPA has a pretty good idea you probably have an account with the IRS, has a pretty good idea you probably have an account with one of the major software providers. They will try your email address and that password with those sites almost automatically. You cannot use the same password multiple sites. You also have to make sure they're long and not easily guessed. There's no way to remember all the passwords you just need to know to do your business as a CPA in tax, with probably sites, links to accounts on state revenue departments, let's say your portal, sites to your, to basically to the irs.gov, to your tax software, to various things that your clients may have. You may decide that, maybe Bank of America, Merrill Lynch, Bank of America, whatever, to send you client information, has set up a portal that you now have access to detailed information there. All those things you have to remember. You can't remember them. You must use a password manager. Strongly recommend you take a look. The major ones out there, things like the RoboForm, LastPass, those sorts of things, 1Password, those sorts of backgrounds. Make sure the number one rule with those, make sure that you use a complex, long password to get into that and memorize. That's the one password you have to remember. Remember that password, and then make sure that the database is properly encrypted, kept in the right place. Do not just simply create a file that you put on your desktop or put sticky notes on your screen. Those are both really, really, really bad ways to do it. Also, the IRS wants all files to be encrypted. That includes all sensitive files and all emails. They have other details that go on there. You can take a look at that. They do want you to check online with this. The one thing they did remove this time, because the National Institutes of Science and Technology has removed it from their standards, is they no longer say you need to change your passwords every so often. That has been a major shift in what the security community believes is the most appropriate, at least NIST does. There are still people who will argue, and there's some disagreement even in the organization that I'm working with here, about whether that's a good idea or not. I'm more in line with the NIST, saying that I think you actually lower your security by requiring people to change their passwords every 6 months, because they are going to, by definition, use the same password over and over again. They're just going to cycle them among sites, and they're going to keep their passwords much simpler, and they're going to put them on sticky notes on the screen, all of which are really, 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 really bad things to do. So I think that removal makes sense. What'll be interesting to see is if the IRS now starts applying it to their own systems. That's a hitch. We always have to update and change our passwords. They've told our software providers to force us to change our passwords on the tax software every few months. We'll see if that change now filters out to those. I'm not so sure there. By the way, key issue for you guys, make sure that you check these publications that the IRS mentioned. If a problem comes up in your office, don't be surprised if in discovery they ask you about that. Also, the IRS notes there's been a larger number of attacks, and this document specifically blames those returns that were filed where there were refund checks, people got out of the blue, then we're told, oh, send the money back here. Those scams were done based on data stolen from tax professionals. So obviously, attacks are still coming. Now let's get to a little more tax news directly, developments. We're going to start here with IRS and some happy news. IRS Notice 2018-61. This was issued here on July the 13th. It was fun. Friday afternoon, I thought I had this done, and then things start coming. This came in after I thought everything was ready this week. The IRS kicked this out about 3 o'clock Eastern, was when they kicked it out about noon here in Phoenix. This actually confirms what I've been telling people in my classes from the beginning of the year. Some people had feared that not only would trusts and estates lose the 2% deductions, which I was pretty sure we're going to lose, but that you would also lose those special deductions that you incur because you are operating as a trust or estate. Those are the deductions that are specifically mentioned in basically Treasury Section 1.67, Treasury Regulation 1.67-4. These are the items that they tell you in there what things would get the 2% haircut and what wouldn't. The issue here is the things that would get the 2% haircut, they're non-deductible to the trust or estate this year, no question. But some people were concerned because of how the code is structured that even things like trustees' fees, right? The fee of the trustee, not the investment management fee, but the fee of the trustee acting as trustee, or the fee of the executor, or other such, the accountant's fee, the attorney's fee, those would also be non-deductible. And things like, the fee for preparing the 1041 would be non-deductible because of what Congress did in Tax Cuts and Jobs Act. I never thought that was an appropriate way to read the law. I happen to think it was a real stretch to go there, but definitely people had raised the concern. The IRS now says, okay, guys, you're panicking over nothing. Those deductions found at 67E, those expenses incurred because you have assets in trust, 67E1 expenses, those are going to be allowed as a deduction. So the shorthand, yes, you still lose the 2% haircut items. Those are simply non-deductible, period. They're gone. Things like the investment advisory fees, for the most part, are gone. But things like your executor fee or fiduciary fee, those are all fine and good. So you can breathe a sigh of relief. If you've taken a course from me this year where we talked about trust or estates, I've done a couple of those this year already, and we talked about this issue, and I told you about that people were concerned, but I thought they were getting worked up over nothing. I was right. They're worked up over nothing. This was not an issue. Now, there is one other issue, though, the IRS is, in fact, going to follow up on here, and that is there's an unusual problem we have right now, which is kind of interesting, on the question of excess deductions on termination. The problem is excess deductions on termination. Again, those are the deductions, right? Those administrative expenses that you incur the final year of the trust or estate that are in excess of your income. And in the past, you pass those out to the heirs. And the rule's still there under 67H2. You pass those out to the heirs. They claim them as a deduction on their return. However, that deduction is a miscellaneous itemized deduction for the individual, which means they lose it. Now, that's interesting because remember, to clear the hurdle I just talked about, it's going to be it's going to be expenses that aren't miscellaneous itemized deductions, on the 1041, including these 67E deductions. Well, the question becomes, does the heir get the deduction, or do the 67E deductions become non-deductible once they become excess deductions on termination? The IRS has indicated that they haven't decided yet how to deal with this. They're asking for comments. If you have a suggestion, which I suspect some of you may have, about how the IRS should handle this, I suggest you read the notice, and then probably wouldn't be a bad idea to submit some comments on this issue. But the IRS is definitely asking about that. So that's an issue that's in play right now. So be aware of that. But if nothing else, good news. And by the way, I'm teaching in New Jersey on, assisting the survivors of decedent's estate a week from Tuesday in their office in Roseland. And unfortunately, the manuals are all done. So they've been out. But yeah, we're going to again talk about this issue there. When you take that course, we're going to mention Notice 2018-61 as an update. And we now have the real answer, even though the manual is going to say we're not totally sure of the answer. We are now sure of the answer. We know how this one's working. The other piece of good news, it does mean that some IRS guidance on the Tax Cuts and Jobs Act is beginning to dribble out. That this is the first big unanswered question that the IRS has actually gotten something out on. So that's useful. Now let's go on to another issue. This is actually another Tax Cuts and Jobs Act issue, but this actually affects 17 returns. This is IRS Information Letter 2018-009, issued on June the 29th of 2018. And what happened in this case was the Attorney General of the state of New Jersey wrote the IRS asking about getting people, if people could get deductions if they prepaid their New Jersey property taxes for 2018. New Jersey was at the end accepting those payments, actually even passed a bill during this session that retroactively said, oh, yeah, you can pay 18 taxes in 17, which I thought was interesting timing, but nevertheless, kind of an interesting mess. New Jersey's writing now. The New Jersey Attorney General is, I feel, in some ways itching for a fight here, because New Jersey Attorney General has also made statements about challenging the service once they bring out those regs on the New Jersey tax credits. So obviously, this is one of those things where, yeah, the New Jersey Attorney General is not asking for this answer because he expects they're going to say, oh, yeah, no problem. No, he's trying to get the IRS on record for saying why they say it's not deductible. Because you may remember, the actual IRS notice in December really didn't say why the service, didn't really give citations about why the service was taking the position that they weren't deductible. Well, no big surprise, the IRS restates their position, stating that they do not believe that those items are deductible. Now, they actually here cite, in this case, basically what the IRS says is they're not deductible, and they cite a case in this one, the Fourth Circuit's opinion in the estate of Hoffman versus Commissioner, which was a case that the tax court decided in the same way, 1999-395. Now, in this particular case, the Fourth Circuit essentially said, we're going to go ahead and we're going to accept, the position here of the tax court. The tax court said if the tax is not assessed, you can't deduct it. But the tax court based that on the decision in Hedresky versus Commissioner, right? Okay. The Hedresky case is, and this is the one I've talked to you about before, is somewhat interesting because that's where the tax court had said previously these people didn't get a deduction because they sent money in to their mortgage company, and an impound account, that's not deductible. You didn't pay it to the taxing agency. Hedresky adds all of these in it. And then one of the things they added was, well, the tax probably wasn't due yet. The court in Hoffman took that to mean, well, that must mean it has to be assessed. So the backup of this, as I've said from the beginning, there's limited, and the service even admits the position has not been challenged often or even been raised often. Nobody cared. But now it's likely to be challenged. There's not a lot of background there. So the question becomes, could you sign a 17 return with this position? Answer, I would say at the moment, is yes, but you better warn your client that the IRS is going to take the opposite position. It's pretty clear they have. Number two, that what we do have in terms of authority all comes down on the side of saying no. Now, it's not great authority, but it does say no. We don't really have a bunch to say yes. Now, the reason, though, you could say yes is 164 says that this is talking about taxes are deductible. Taxes that are accrued or paid are deductible. Well, Hedresky just says, or I should say Hoffman then especially specifically says, that the tax obviously is not yet accrued. But that's fine, and I can understand the reasoning that if it's not assessed, it's not yet accrued. But the problem is that kind of ignores, but there's that or paid clause. And that or paid clause is what everybody's hanging their hats on if you're going to try to claim this as a deduction. We'll just have to see what happens here. I certainly expect legal challenges. I would not be surprised to see the state of New Jersey basically try to ready some sort of challenge based on this. We'll just have to see how things work. It's a little bit funny trying to figure out how they get to court, but we'll see what happens. Next up, we have the IRS. This got lots of coverage this week. Tax Talk Today webcast on July the 10th of 2018. Now, Tax Talk Today is the IRS's webcast they do. It's meant to update people on tax issues. They offer some CPE credit, and it's a basic structure they do. But on that date, on that 10th date, a IRS employee Donald Kiefer Jr., who is a tax law specialist, employee plans and rulings and agreements of the IRS tax exempt and government entities divisions, commented on what we know as the backdoor Roth IRA contribution. Okay, so we have this employee commenting. This is, now, as you may remember, Roth IRA contributions are limited if your AGI goes above certain levels. And those levels are very much in the same level as which you can no longer get a deductible IRA if you are married and covered by a spouse's plan. If you're single, you lose the deductible earlier. But, and I mean, your spouse is covered by a plan, I should have said. But here's the catch. What you can do is at any time convert your IRA, your regular IRA funds, to a Roth IRA. And there's no limit on income based on that. So the backdoor Roth IRA works like this. If you have no current regular IRAs, and in the write-up, I have an example. I tell you about why having regular IRAs already in place makes this not work nearly as well. But let's say we have no regular IRAs in place. We make a maximum non-deductible contribution to the regular IRA. Okay, that goes to that regular IRA account. That anybody's allowed to do if you have the earned income. We then turn around shortly thereafter and convert that regular IRA to a Roth IRA. Based on the rules, that's going to be considered distribution of the regular IRA, but we're going to get a pro rata share of our basis. Since we're taking 100% of the funds in the regular IRA, and by the way, it does not help to set up a separate regular IRA if you already have one. All IRAs are combined under this test for how we compute how much basis we get. But we get 100% of our regular IRA accounts are going into the Roth. Therefore, 100% of our basis comes over. So that means the only thing we're going to pay tax on is whatever minor amount of earnings we've had in that account since we set it up. That then goes into the Roth IRA, and voila, we have established and contribute to a Roth IRA, even though we're over the income limits. Well, that's great, except that obviously is, the law that seems to be, using a backdoor way. It seems like there's all kinds of, arguments that could be raised about why maybe that doesn't work tax-wise. So many of us were a little bit uncomfortable. I mean, you advise clients to do it. I might have advised clients, like I've been known to do it, saying, why don't you make that contribution in December, and then why don't we convert it next year so that we have at least some time in there, have it in there for a while so there's a risk of change, various things. Because you're worried about the IRS potentially attacking this as a scam, as a sham. So, you're trying to say, well, if you do it, it's allowed, but, so you want to get some comfort level. But in this particular broadcast, Mr. Kiefer said that, look, Congress had said, basically, if you look at the committee reports for the Tax Cuts and Jobs Act, which is not really called that, as we know, but nevertheless, if you take a look at the committee reports there, they had basically said that this was okay, and they were only getting rid of, that bit to reclassify in October. But they still said the backdoor Roth IRA is okay, and they were not taking that out. Therefore, he's saying effectively it's legal. And even though this is a sort of thing that should, and he says normally the IRS would be very concerned when they see things called workarounds or something whose name is backdoor, that this particular case, it's all fine. The IRS is not going to challenge you on this issue. That's an interesting deal. Certainly, it makes you feel a lot better if you have a client that's currently setting this up. But again, only really works well if they have no regular traditional IRA fund accounts right now, that all of them are gone. By the way, a planning tip: if your client participates in a regular employer plan, quite often you're going to find that you can actually roll from the IRA into the employer plan. Now, do that with some trepidation, because once you do that, those funds are under the control of the plan document, and you're probably going to have nearly as much investment leeway as you do currently. But arguably, you may get better costs because they're paying management fees over a much larger amount of money than your client had sitting in their pension fund, than in their IRA. And secondly, once we get this clean, so that starting the beginning of next year, we have no regular IRA account numbers, then we're back to, we can basically start with a clean deck, and we can start doing this Roth transfer without having any real problems. So if a client's interested in that, you might try to see if there's some way to get those regular IRA funds into a qualified plan to get rid of having regular IRA funds. Well, as always, this has been brought to you by your state societies of CPAs. I want to remind you, be sure you take a look and sign up for classes that the society is offering. As I mentioned, a week from Tuesday, I'll be doing a session in Roseland. It's going to talk about, trusts and estates. I'll be doing that one. I'm also going to be at the same time, I'm going to be taping some material for Smart Pros, actually the weekend before. So I am going to warn you, next week's broadcast could be delayed if I can't find a good enough internet signal until, worst case is, until I get back to Phoenix, which may mean it won't get posted all the way until Thursday because of various issues I've got. I think absolute worst case, I should be able to do it Wednesday morning before I leave New Jersey. Should be able to get something up because I've stayed at that particular hotel and actually broadcast a webcast session from there before. So everybody's staying Wednesday night. I'm pretty comfortable with their Wi-Fi. I just don't know about the two hotels I'm going to be staying at in the interim. But if I can, I'm going to try to get it put up on Saturday while I am in Westchester County in New York. But just be aware of that. That could be a problem with next week's session. But otherwise, be sure to check your states for live stuff like the session I'm doing in New Jersey. See what's coming up. We've got lots of things happening this year, lots of things going on. This has been the current federal tax developments for this week of July 16th. You can get our regular updates online. Check our website, currentfederaltaxdevelopments.com. You can also send questions and comments to me, Ed Zollers at currentfederaltaxdevelopments.com. Follow me on Twitter at Ed Zollers. And also, I do follow discussions on the subreddit of reddit.com/r/taxpros. You can find me there. I'll follow along discussions there. I also monitor a couple of state society sessions. I do Arizona. Obviously, I'm here in Arizona. I'm a member here. I also follow California's Tax Talk, which is open to anybody in the country. So you might want to take a look on that site. I've also started following New Jersey's because I do a lot of stuff over there. So I decided associate membership made a little sense. So I'm starting to follow what New Jersey's talking about. Interesting discussions over there too. So be sure. By the way, your state society has such a system. You might take a look at it. Tax people like to talk, and using it, bouncing it off your colleagues is not a bad deal if you have an option to get it. If not, take a look at going to the Yahoo groups and getting to Tax Talk. If you want to email me, I can probably get you as to how to get the Yahoo groups thing set up, so you can get yourself approved to get in there. But anyway, going to be an interesting week. Hopefully, I'll see you. If worse comes to worse, it may be delayed till Thursday of next week. But hopefully, we'll get everything together. I'll be able to record and send this up from New York. And look forward to seeing you in the future as we talk about these issues dealing with current federal tax developments.